Hello, I'm CPA Yusuf. Today we are diving into IPSAS 3, Accounting Policies, Changes in Accounting Estimates and Errors. This IPSAS 3 provides essential guidance for public sector entities on how to select and apply accounting policies, handle changes in estimates, and correct errors in financial statements. Understanding this standard is crucial for ensuring transparency, consistency, and accuracy in financial reporting. Let us explore the key principles and practical applications of IPSAS 3 to enhance your knowledge of public sector accounting. Remember to subscribe for more insights on other IPSASs and stay updated with our tutorials. The objective is to prescribe the criteria for selecting and changing in accounting policies, changes in accounting estimates, correction of errors. You may have seen in other IPSASs that they prescribe the criteria for recognition, measurement, presentation in financial statements, and how to disclose those accounting standards. But this one is a little bit different because it guides on how to select and change in accounting policies, changes in accounting estimates, and how to correct those errors. The scope, it applies to all public sector entities, same way as the objective, when selecting and applying policies, accounting for changes in policies, changes in accounting estimates, correction of those errors. As we go deep into this, you may hear me talking about retrospective and prospective. Retro means going backwards, prospective means going forward. So retrospective application is applying a new accounting policy to transactions, other events and conditions as if that policy had always been applied. Like when you go backwards and apply the accounting policy, it's as if you have been applying consistently. So it's like something natural that was happening consistently over the years. Retrospective restatement, when restating the accounting policy, is correcting the recognition. So you correct how you are recognizing, how you are measuring, and the way you are disclosing those amounts of elements of financial statement as if a prior period error had never occurred. Which items do we apply retrospectively? Accounting policies and major material errors on accounting estimates. The key aspects of retrospective application. When doing retrospective, we look at historical adjustment. The entity adjusts prior period financial statements to reflect the new accounting policy or corrections if it already applied. Normally, when doing financial statements as guided under IPSAS 1, there is the current year and the comparative year. So for comparative information, for previous periods presented in the financial statement, it is restated to ensure consistency and comparability. Those opening balances of assets, liabilities, and equity for the earliest period presented are adjusted as if the new policy or correction had always been in place. So the opposite of retrospective is prospective. Prospective we normally apply on estimates and non-material errors. In government, materiality is judgment-based, but we'll cover that in our next slides. So we consider refers to the application of new accounting policy or correction of errors in such a manner that the new policy or correction is applied to transactions, other events, and conditions occurring after the date of change of correction. So what aspects do we normally consider? We consider future transactions. The new accounting policy or estimate or correction of error is only applied to future transactions and events. Here, there is no restatement. Unlike retrospective application, there is no need to restate prior period financial statements. Current and future periods. The effects of the change are recognized in the current and future periods affected by the change. Example, if an entity changes its method of depreciation from straight line to reducing balance, under prospective application, this change will only apply only to the depreciation calculations for the current and future periods. Prior period financial statements will not be altered. Where in retrospective, when you change the accounting policy, you apply even on the previous period. For example, for retrospective, you look at moving from cash basis to accrual. So when recognizing assets, you don't just recognize future assets, you go back and recognize previous assets and liabilities. So the major difference between prospective and retrospective is retro, you go backwards. Prospective, you go forward. K, materiality. Information is considered material if its omission, misstatement, or non-disclosure could influence the accounting decisions of users taken on the basis of the financial statements. In government, we say even 1 shilling is material, but there is something that is more material than others, which is dependent on judgment. The assessment of material reality involves judgment. It depends on the size or nature of the item or error or a combination of both. In the context of entity financial statements, only items or errors deemed material require change in the accounting policy or corrections to be applied retrospectively or prospectively. Change in accounting policy. When an entity changes the accounting policy, it must consider whether the change is material. If the change is material, it must be applied retrospectively, unless impracticable. If not, the entity may not need to restate prior periods. Similarly, correction of errors. When correcting errors, the entity must assess materiality. Material errors must be corrected retrospectively to ensure accurate and reliable. We also need to disclose all materiality that affect financial statements. Material items require detailed disclosures to provide users with relevant information, while immaterial items may not need the same level of details. Example, if an entity discovers a minor calculation error in the financial statement that does not significantly affect the financial position or performance, it may deem that error immaterial. Consequently, the entity may decide not to retrospectively correct the error and instead address it in the current period. Accounting policy. What's this accounting policy? Accounting policies are what we call, these are specific principles, conventions, bases, and rules applied by an entity in preparing and presenting the financial statement. So what are these principles? Imagine you are a group of friends who decide to start a small business selling homemade cookies. To keep track of their business, you decide on certain principles. If you agree to record all transactions accurately and honestly to reflect the financial position of your business, then that's a principle. The convention. We will now move to conventions. What are these conventions? If you decide to use the convention of historical cost, meaning you will record the packing equipment, the price you paid for when you bought that item, then that's the convention. What's the basis? The choice you make, whether you go accrual basis of accounting or cash basis of accounting. For example, you record cash when you receive. You record revenues on cash when you receive and record revenues for accrual when you earn, whether cash is received or not. Those are the basis. The basis can be cash basis or accrual basis. But if you go to IPSAS 46, Basis, the word basis may have different meanings. For example, the basis in measurement are either historical cost basis, current operational value basis, cost of fulfillment basis, and fair value basis. The models are historical cost model and current value model. Then there are techniques which you will measure, which you will use to measure. Those techniques are market income approach or cost approach. At the beginning, all those might seem similar because you're using fair value. Fair value, we say, is the price someone will sell an asset or extinguish a liability between market participants at arm's length. So these accounting policies for the word basis can have several meanings. Rules. They establish specific rules for example, when those who open that business establish rule for inventory valuation, such as using the first in, first out, FIFO method or weighted average method to determine the cost of ingredients used in baking each batch of cookies. Okay, now we can move to the next when selecting or selection of accounting policies. When an IPSAS specifically applies to a transaction, the standard is applied. The standard is applied when you are applying to when you are applying IPSAS to a transaction. The standard the specific standard is applied. In the absence of specific IPSAS applicable, management shall use its judgment after considering the following. So there is a hierarchy. You look at similar IPSASes. How does that IPSAS handle similar about other similar issues? If there is no IPSAS or IS or IFRS, you go to conceptual framework. If the conceptual framework doesn't talk about on those issues, then you go to other financial reporting rules like generally accepted accounting standards, principles. If then generally accepted or GAAP doesn't talk about those, then you use best practices. And here is where the hierarchy of selecting accounting policy comes in. The guidance. Normally, every IPSAS is accompanied by implementation guidance. IPSAS are accompanied by guidance to assist entities in applying their requirements. All such guidance states whether it's an integral part of IPSAS. If it states it's an integral part of IPSAS, then that is mandatory. By the way, guidance which are mandatory are part of that IPSAS. Consistency. The accounting policy selected shall be applied consistently to each category of transactions from period to period. We say accounting consistency is accounting principle. The reason is to enhance uniformity in presentation and comparability of financial statements of a period. Unless an IPSAS specifically requires or permits the categorization of items for which different policies may be appropriate. If an IPSAS requires or permits such categorization, an appropriate accounting policy shall be selected and applied consistently to each category. When to change accounting policy? Changes in accounting policies are permitted under the following circumstances. IPSAS 3 paragraph 17. Change is required by IPSAS. If the change is required by IPSAS. If the change will provide more relevant and reliable information on transactions and reliable information on transactions with a material effect on the financial statement. For example, someone is migrating from cash to accrual because accrual provides more relevant information and which are more material. What you have been keeping off balance sheet is transferred to the balance sheet. If you are hiding those receivables, those assets, those liability, and you change your accounting policy to accrual, then that is more, you are providing more relevant and more reliable information in transactions. When IPSAS is required, when IPSAS forces you or guides you, for example, IPSAS 13 used to guide that rent is written off as an expense. Now, IPSAS 43 came in and guides that we capture in the balance sheet as right of use asset. And so when a new IPSAS comes in and requires to change your accounting policy. Okay, what are accounting estimates? Estimates are monetary amounts. Estimates. By the way, estimates come from the accounting policy. For example, you may be applying IPSAS 17, property, plant, and equipment. We're using your historical cost model. Then you depreciate your equipment or motor vehicles. So the depreciation rate or the value that arises out of the useful life of that asset are called depreciation estimates, which we say depreciation is always a management estimate. The monetary amounts, the values. Examples are tax revenue due to the government. Those are estimates until received. Bad debts arising from uncollected taxes. Inventory obsolescence, debt provisions, and more. Prospective applications apply the change in accounting estimates to transactions occurring after the date the decision is made. So most of the times estimates you apply prospectively. Change in accounting estimates. When to apply? When circumstances change. New information or development or experience. For example, you had a vehicle, you are depreciating at 20%, but you may see or find that due to past experience, that this vehicle can serve you for the next 10 years instead of 5 years. So you change what? Your estimates. Estimate application. A change in estimates is applied prospectively. It may affect either the current surplus or deficit, so the current. It only affects the current and future surpluses. A change in the measurement basis applied is a change in accounting policy, as not a change in accounting estimate. So when you change the measurement basis from cost to fair value, or you change from historical cost model to revaluation model, then that is not a change in accounting estimates. Even though that's applied under IPSAS 17, that change is applied under IPSAS 17. But sometimes it's difficult to distinguish a change in accounting policy from a change in accounting estimates. For example, changing from reducing balance or straight line method to income approach or cost of or unit of production approach. So changing your depreciation policy from straight line to unit of production approach, that may look similar to a change in accounting policy, which should be applied retrospectively. But if you cannot identify or you cannot determine which switch, then treat it as accounting estimate. So what's the difference between accounting estimates and policy? Accounting policy is, these are principles, measurement basis. Ni kama baba, it is the father of accounting estimates. Accounting estimate are the amounts, pattern, parameters, the 20%, the 2000, the figures. Example, change from cost model to fair value under IPSAS 16 or IAS 40. Example of accounting policy. The accounting estimate, change of the provision on fair value. So the 20%, the 10%, the 15% of the depreciation amount. Errors are omissions or misstatements in the financial statement for one or more prior periods. There may be mathematical errors, accounting policy errors, or facts misinterpretations. Example of an error, it is correction scenario. In 2023, an entity discovers that it incorrectly recorded revenue from a long-term contract in 2022. The contract should have been recognized over time based on the status of completion, but instead, the entire revenue was recognized after in 2022. Suppose the contract was for 5 years, and each year you were to get 100,000. The total amount of the contract was 500,000, but you recognized everything. So for you to correct, you have to go backwards. You correct retrospectively because that's an error. You correct year 1, 100,000, year 2, 100,000, year 3 instead of. So you correct your surplus and also treat it as a liability in your books. Even though your cash has increased, but you are applying accrual basis. So the assumption here is you are applying accrual basis, not cash basis. Cash, you may treat it as revenue, but for accrual, you will treat it as, you will treat revenue when it's earned, not when cash is received. And that's an error you need to adjust. Material errors. An entity shall correct material errors, prior period errors, retrospectively, in the first statement authorized for issue after they are discovered. So by restating the comparative periods for the prior period, it shall be corrected retrospectively except to the extent that it is impracticable. So sometimes adjusting those prior periods statement is not easy or it's not practicable. You may not know what relates to, but you may know in the current period or in the opening balances how much of that will go. So you can apply either by restating those opening balance, those statements, or doing it on cumulative effect at the beginning of the current period. Reset those comparative information to the earliest period. Thank you. This is end of our overview of IPSAS 3, accounting estimates, accounting policy, estimates and errors. Subscribe to our channel for more IPSAS videos. Thank you for your time and enjoy your day.